just beg 2 minutes of your time, if I may, John, because it was remiss of me. I should have mentioned something earlier in my presentation. There was an outstanding sporting achievement 2 weeks ago. Happened at Peregian Springs in Queensland. There was a reasonable golfer named, well, drop names around here, Keith Ross, run into a ordinary sort of golfer named Brian Simpson and said, let's have a game. So Keith Ross had a good drive off the first, then it all turned to whatever, and this ordinary golfer, as it annoys you sometimes, for the next 17 holes proceeded to try and help this Keith Ross out, rescue this terrible game of golf. By the 18th hole, I'd fixed his game for him. He could not get a ball anywhere near the fairway. And lucky he's a professional player and gets his golf balls for nothing, because I wasn't counting, but he lost at least 5.
True story?
True story.
What a mate you are.
Was certainly lost. In fact, it was so bad he was going in the bushes to try and find another one. And lo and behold, before I broke my phone, I'm looking at the results the next Thursday at Victoria Golf Club. Who was the winner? Who had a hole in one? Who won this Secret 6? God, I'm a good coach. Well done, Brian. Now, in a moment, we'll have our guest speaker today, John Hewison, one of our own. So that's really, really good. And John's going to try and tell us what went wrong with the financial system in Australia, the brutal facts about the regulations stand, the financial planning in Australia, weaknesses and regulatory change, and finally the fallout from the Royal Commission. I think we need a Royal Commission ourselves once we sort all that out. Anyhow, John, please welcome to the club, and we look forward to hearing what you have to tell us. Thanks, John.
So I might start with a postscript to the Brian Simpson story, because I had 40 points last Thursday and came second.
Oh.
Not happy. There's a rule about the pros winning amateur competition.
Oh, and they've changed the bloody rule.
Anyway, look, thanks for letting me vent my spleen and share with you my frustrations of the past 25 years of dealing with incompetent politicians and hopeless regulators. Finish it up with the mess that we see that we're in now. I should first start with the legal part of my talk, and that's basically that I take no responsibility for anything I'm going to say, and if you act on anything that I say and it goes wrong, I'll deny that I ever said it. But in all seriousness, this is general advice, and you should always seek professional advice from a qualified person. I'm going to start my talk by making 3 statements which may surprise you. If I can get... This is obviously a subtle way of working this, and I haven't got it. Philip, I'm going to let you do this. We can go back to... So the first statement is that Australia is considered to have one of the best financial services regulatory system in the world. And I have to say to you that the regulation system in Australia is robust, detailed. It protects the client interest. It covers all things like suitability of advice, fiduciary duty, supervision, and all of the things that you'd expect it to cover. But there are problems with it, and the issue, of course, with any regulation, it's no good if the regulator doesn't regulate it. And that's one of the big problems. My next statement is that Australia is considered to be the global leader in financial advice professional practicing standards. I had the privilege of spending 6 years involved in the international, the Financial Planning Standards Board, which is the international board that governs the Certified Financial Planning Professional Standard. And I can tell you that Australia is by far and away the leading country in the world in respect to financial planning standards. But obviously there's a clear distinction between what is a certified financial planner and what is somebody who's acting under the regulation but doesn't have the same sorts of academic qualifications, professional codes of standards and disciplinary procedures. And my next statement is that I'm extremely proud to be a certified financial planner. I love the work we do to improve people's lives and protect them from harm. You know, I love my job. It's fantastic. I go to work each day, or I used to, I'm semi-retired now, dealing with lovely people, forming long-term relationships, talking to them about their financial hopes and dreams and their objectives, working out strategies to make them work, and enjoying a long-term relationship. And that's what financial planning is and should be about. So what went wrong?
AMP.
Do we want to add a few more names to the AMP name? What went wrong? Well, the issue is that the statements I've just made are true. And what I'm planning to do this morning is go through where the issues exist in the financial regulatory regime and its administration, and where further change has to take place. I'm not here to promote my company, but I'm going to use my company as a comparator for some of the wrongs that have taken place to just give an illustration where there are plenty of good financial planning firms in Australia, and they operate under totally different standards than the standards that we read about in the newspaper or we saw at the Hayne Royal Commission. So the first thing is that I need to explain how the financial services regime works in Australia. So this is a hierarchy diagram of how a typical financial planning company would work. And it's basically a licensee agency type structure, which probably comes from the life insurance industry, I would imagine. So one Australian financial service licensee can have any number of corporate authorised representatives. And those corporate authorised representatives can have any number of advisors. So you finish up with this pyramid structure that has all sorts of complexity in it, and you don't actually know who you're dealing with. The problem with this structure also is that the client's interests are compromised by corporate greed. And I'm going to say some more about that in a bit later. I'll just give you an example of a typical structure of a corporate licensee. So this is IWF Group, and I've picked IWF Group for a particular reason, in that they are sopping up the fallout from the Hayne Royal Commission. That a lot of major institutions are getting out because of compliance. The compliance cost is way too expensive. And any of you that have been to financial planners will probably have been asked to fulfil a risk assessment questionnaire. And this is a compliance mechanism that corporates use, because if you take the Commonwealth Bank, have got thousands of advisors throughout Australia, there's got to be some mechanism for them to contain what their advisors are saying. So they use a risk profiling mechanism. So you sit down and you fill in a risk profiling questionnaire, and it categorises you as a conservative or a balanced or a high risk investor, and then a computer spits out a portfolio and there you go. It's absolute rubbish. We've never ever... Can we just have a show of hands? Who would be happy about losing money through an investment? I've just done a risk assessment. Nobody is. So everybody's risk averse. And it's a matter of the way we approach financial planning with our clients is that we go into great detail of talking about their objectives, what they need to achieve, long term, short term, medium term. It can become very emotional because often it involves children and other things. And then it's our job to then develop a strategy that's going to achieve those outcomes. And then it's a matter of assessing whether they're prepared to take the risk. And in most cases, I mean, we're not high risk investors anyway, but in most cases you can achieve the outcomes without having to take too high of a risk. So we're not interested in risk profiling. I'll just go back to the previous slide. I want to talk to you about the example I'm going to use is Shadforth, and I'm not meaning to demean them in any way. I'm just going to use them to illustrate structures to you. So Shadforth is part of the IWF group, and it came out of a consolidation. And the reason that I know about Shadforth is because they were desperate to have us join their consolidated model. So what they did was they approached 14 major independent firms throughout Australia, and they said, we'll all join together and we'll form a company and then we'll float it on the stock market. And so what that would do is change a private company's price to earnings ratio from 5 to 1 with 10, being a publicly listed company. And I just laughed at them. I said, you're going to be kidding. They tried to tell me that they're all going to retain their entities, they were going to be able to deal the way that they dealt before. And I said, you're just fooling yourself. Because the only way consolidations work is economy of scale. So you've got to build a centralised administration, centralised operations, and so on. And that's exactly what happened. So Shadforth went out, put in centralised administration and procedures. They negotiated badged product with a fund manager, so they had Shadforth products, and then they developed a platform, administration platform, under the Shadforth brand. So all of the clients would then move from other investments into the Shadforth brand. Then IWF came along and took them out, and they all walked away with a lot of money. My question is, where's the client interest? This is all greed, it's all self-interest. No interest about the client whatsoever. How many clients paid capital gains tax when they flogged their investments and put them into another product? It's just not right, and it's not acceptable. This is a big problem. Let me compare now with what an independent licensing model is, which is like our firm. You've got an AFL licensee and the clients. That's it. The licensee employs their advisors. In our case, all of our advisors, their senior advisors, own the company, and they deal with their clients. And they work based on the client's interest. No product interest whatsoever. We select products that suit the client and do the job for the client and achieve the outcomes of the client. So you can see the distinct difference between one model and the other, and the problems that can occur with the corporate model. That's what we've seen with AMP, CBA, all of the banks who are now getting out. My contention has always been that you can't corporatise professional advice. And it's been tried in many professions in Australia and around the world, particularly accounting, medicine, and financial planning. And I've had experience with a friend of mine who was a chartered accountant, and he sold his business to a listed company called Investor Group, which then became WHK. And their Their charter was to buy financial planning groups and accounting firms and marry them together so that they'd cross refer clients to each other. Well, it just didn't work. It didn't work for two reasons. One is that the professional people have ownership of their client and they don't like to compromise that ownership. And the other reason is that the corporate agenda is entirely different to a professional agenda in terms of their drivers. Corporate entity, the driver is profit and growth. A professional advice firm, the driver is delivering good quality advice so you keep the client happy and the client will pay your fees. Totally different drivers, and I come from a corporate background, so I know the difference, and it's just chalk and cheese. The other issue is the issue of education standards. And education standards, this is a hobby horse of mine, has been for a long time, that the education standards in the regulation right now come under a clause called Regulatory Guide 146. So you can be a financial planner with 4 units of a diploma, and you can get that in about 6 weeks. It's just ludicrous. Again, to use our firm, in 1995 we introduced a graduate mentoring program, so that our financial advisors come from they either have to have a business or a commerce degree. We appoint them into our mentoring program while they do their postgraduate studies in financial planning, usually a graduate diploma, or these days they usually do a master's. And then they have to do the certified financial planner designation, which is 6 units at master's level. This is compared to a 4-unit diploma course, which is the regulatory standard. It's a bloody disgrace, and it's been that way until just recently, and I'll go through the changes that are about to occur. So the other regulatory issues is that I could bang on to you all day long about investment strategy or financial planning strategy, and I wouldn't need to be licensed. The minute that I talk about a product, I do. And this, I know there are any accountants in the room. This is it's an absolute joke, but accountants have been advising on self-managed superannuation funds forever. And now all of a sudden they're required to be licensed under the licensing regime because they can't tell a client to open a bank account, because a bank account's a financial product. And ASIC have determined that an SMSF is a financial product. It's just regulation gone mad, so it goes from one extreme to the other. But of course the large institutions need to have a low level of education standard for people in their organisation who are selling product. So it's a one-size-fits-all standard, which is just absurd. And the model has been historically institutionally driven, which suits the regulator fine, because 80% of the financial advice profession is governed by about 6 institutions: banks, AMP, and so on. So it's easy, makes their job easy. They can cover off on 80% of the industry by just covering off against 6 institutions. But their method is not to hold them accountable. I mean, if a company like mine did what some of those companies did, which was revealed through the Home Royal Commission, we'd lose our licence, we'd be out of business. But they're too big. So what they do is go for the deep pockets. And they just say, we'll give you what's called an enforceable undertaking if you write the cheque to the client. And that's been their attitude. So nothing improves if you take that attitude. The regulators also been totally reactive. We've got no proactive involvement in the industry at all. We've had a financial services licence for 25 years. Never once has ASIC visited our office. Haven't even phone calls and said, I mean, it's just ridiculous. And I've already covered off on the education standards. The huge issue in the industry right now is what they term as vertical integration. And vertical integration is common in businesses, but in terms of the financial services industry, it's referred to the vertical integration of the banking industry, where the bank manufactures the product, owns the product, controls the product, and distributes the product, and clips the ticket all the way through. And it's been estimated, not by me, but by industry people, that the overall cost of that integrated model to the client is 4% per annum. It's just outrageous, particularly in this area of low interest rates. To be able to justify a cost of 4% per annum is just outrageous. I can tell you that we're a very high touch, high level service model, and our fees are less than 1%. So it's gouging, pure gouging, it's all self-interest. There needs to be a separation between product and advice. You can't have advisors advising under the auspices of a company that makes product. You cannot get away from conflict of interest. And even though the institutions claim that they have many products that they don't control on their lists, ASIC's research showed that AMP, for example, 65% average of the client's product is AMP product. So you can talk the talk, but you've got to walk the walk. Our view is a financial advisor should have no interest in any product. I recognise that the institutions need to have product advisors, and they probably don't need to have high levels of qualification. But if somebody's going to call themselves a financial advisor and hold themselves out to advise people on their life savings, then they need to be appropriately licensed and have appropriate education. So one of the moves that's been made is that the terms financial planner and financial advisor have now been embraced in regulation, and you have to meet certain standards to call yourself a financial planner. So let's look at this is that vertical integration model, and you can see how it just passes down from the licensee. It manufactures managed funds. It manufactures a wrap account, and wrap accounts are huge. They're an administration platform that advisors use to manage their clients' portfolios. There are all sorts of issues with this model. I'm just going to take a few minutes to explain to you. Firstly, managed funds obviously have a cost, and that cost includes all sorts of things, including the ability to get listed on a wrap account. So you have to pay to get listed on a wrap account. The wrap account pays a fee to the advisor, as well as paying a profit to the AFSL, and then there's the advice fee. So you can see there's all of these snouts in the trough that are adding up to this 4% per annum that people are expected to pay. So what's happened in terms of legislative change? We started off with the Future Financial Advice Act in I think it was Julia Gillard's government in 2014, and after an inquiry, commissions were banned, which I had a party that night, because we've been banging on about commissions for as long as I've been in the. I never understood them when I came from a commercial background into people being the advisor being paid by the product manufacturer. Just never made sense. However, the government, in their wisdom, chose to grandfather existing arrangements. So that meant that something of the order of $500 million a year of training commissions remained in place. And most of those clients wouldn't even know that they were paying it. And I remember went to an FPA convention, and the minister in charge was there speaking and took questions, and this guy got up. And part of the legislation is that you had to provide your clients with an opt-in notice once a year, which they now make once every 2 years. So it means that advisors have to send a notice to their clients saying, this is what I've done for you for the last year, this is what I've charged you for, will you opt in? So it's not an opt-out. If the client doesn't say, yes, I'll go on, it stops. So this guy gets up and says, how do you expect me to contact hundreds of people that I've never met and tell them I'm going to charge them fees? And I sat there thinking, well, you just answered your own question, you idiot. And that's what goes on. And people buy books of client books with fees in them, and they just take over a cash flow. It's just ludicrous. In 2016, the Turnbull government introduced degree-based education, which was again something we've been trying to get introduced for the best part of 20 years. But I'll let you into. I had just before the 2016 election, I had a lunch with Josh Frydenberg in Canberra with a couple of colleagues, and we debated various issues, including degree-based education and various other things. We wanted them to introduce compulsory membership of a professional body and a disciplinary regime, which he rejected, saying would be politically unpalatable to his colleagues. But he then went on to say that he just met with the CEO of the Commonwealth Bank of Australia, who absolutely assured him that they had the client's best interests at heart. Josh made the mistake of taking from that meeting, put me on his email list. So I had great pleasure in sending him an email saying, well, how are you feeling now, Josh? Politicians just listen to the noise, and of course the big end of town's got a lot of lobby clout in Canberra, and it's very hard to fight against it. We now have an organisation called FSAIA, which are financial. Anyway, it's the Education Authority. And they are responsible for. There's been over the past 5 years or so, a committee working toward the development of a standard financial planning degree throughout Australia. One of my colleagues sits on that committee. FSAIA has taken over that role, and there is now a financial planning degree, which is available in a number of universities and growing by the day. They're also involved in setting education standards for planners and what hoops they have to jump through to reach the standard. And as I said, the financial planner and financial advisor have been enshrined in law. So there's also some work in progress which has come out of the Hayne inquiry. They have now banned the grandfather commissions, thank God for that. So it means that those people who are stuck in financial products that carried commissions before the Gillard change, those commissions will now be banned. There's another side of this grandfather commission thing that I think the government just did not understand. That if you were in products that carried commissions, and even if those products didn't perform, or there were newer products that did a better job, there is no way in the world that advisor is going to tell you to change, because they lose their income. There's no question that the government and the regulators are hot on commissions of any sort, and particularly life insurance commissions and mortgage broking commissions. And rightly so. I mean, the life insurance, I think the life insurance industry has just done themselves no favours. Because I think most people don't understand that in many cases, if you buy a life insurance policy, sometimes 100% of your first year's premium goes to the advisor in commission, and then something like 30% of your subsequent premiums go to the advisor in commission. It's just, you just can't justify that level of cost. We've recently, in the last 2 years, put on a life insurance specialist who's also a certified financial planner, and we do our life insurance advice and facilitation based on a fee basis, which has been very well accepted. Then the ban on mortgage broker commissions, well, I mean, how a mortgage broker can justify an annual fee for a 35-year home loan that he's never going to change, or she's never going to change. It just isn't right. And I think the same way as financial planners have had to step up to the mark and justify their existence and say, well, I'm a valuable resource to you. This is the value I bring to the table, and this is the fee I'm going to charge for it, the same as any other professional does. These people need to do the same thing. And I think the writing's well and truly on the wall. That's what's going to happen. So some of the work in progress things, the ban of grandfather commissions is about to go through the House and be, I'm sure it'll go through. Let's go on to the fallouts. There's going to be some huge fallouts from the Hayne Royal Commission, and it's probably the reason why government has been reluctant to act earlier, because of the lobby from the institutions. But it's been estimated that 30 to 40% of financial advisors will disappear by 2024. I actually think it's going to be higher than that, because the last figure I heard already is 20%. And a lot of this is because a lot of the large institutions are getting out of the financial advice business. There's no money in advice for an institution, none whatsoever. All the money that they make comes from their products. We're seeing a couple of new big players in the advice business, and that's IWF and Netwealth. I saw the Netwealth only floated a couple of weeks ago, and I saw the CEO being challenged about their business model, saying, well, what's going to happen when all of these people need to have a degree-based education, and they'll have to leave the industry or get one, and most of them aren't. And he said, oh, well, we'll worry about it when we come to it. And all they're worried about is getting the client on their register and getting the funds under their management. They'll worry about the other stuff later. Prices will fall, and they've already started to fall with the ban on grandfather commissions. A lot of fund managers have cut their fees, and I think we'll see more fee cuts, more downward pressure on costs, which is great for the consumer and the way it should be. Because all these fees have all been loaded with all sorts of kickbacks and sponsorships and all sorts of stuff. And I think we'll see a rise of the financial planning profession as we know it, as we have a degree-based profession. We'll be working hard to ensure that we have the right levels of disciplinary procedures. I mean, the Financial Planning Association has a very robust disciplinary procedure, but the government's chosen to put something else in place. But as long as it happens, it doesn't matter. So I think the fallouts are going to be huge. I think there'll be a lot of clients that are going to see their advisors disappear, and that's a problem. And there needs to be an influx of new blood, new talent into the profession. But that is happening. A lot of at the moment we have 7 associate advisors who are graduates, who are sort of in various stages through their 5-year mentoring program. So we're going to be hiring more, and I think that's going to happen throughout the industry. So there's a way to go. This vertical integration thing is a big issue, and we were at a convention a couple of weeks ago, and a couple of ASIC commissioners were there addressing the convention, and we asked the question, what's your view on vertical integration? And they said, well, it doesn't matter what you call it, it's a conflict of interest and we don't like it. So the regular doesn't like it. That being the case, and Hayne said in his summation that he didn't like it either. So I think the writing's on the wall with vertical integration. I've been asked to, I'm happy to answer questions on all of that, but I've been asked to talk a little bit about recession proofing, which I will do. Is Australia going to go into recession? Personally, I seriously doubt it, and one reason why is that the iron ore industry is booming at the moment, caused by obviously demand, but Brazil had a tailings dam disaster which led to them cutting down 38% of their production for a 3-year period. So Australia is going to be the beneficiary to that, both through increased iron ore prices and increased demand. So I think that's one reason. The government seems to have got the GDP into some form of equalisation. There are still plenty of signs, that recessionary signs, like a growth in unemployment and other things, but I seriously doubt that we're going to get into an official recession. But nevertheless, we're going to feel, I thought we should have gone into recession in 2007-8, would have been better off. But we managed to get through that because of the mining boom, pig bats, school halls and a few checks here and there. But probably we would have been better off to have had the recession and made the adjustments. So I think if coming into recession, it's probably a bit late to be making bulk changes, but I think as a matter of principle, overall we should always be recession proofing, or proofing against all sorts of economic volatility and market volatility. And that comes down to developing a strategy plan that is aimed to achieving certain outcomes, and sticking to that strategy plan no matter what. That when markets fluctuate, you make adjustments within that strategy plan to make sure that it keeps faith with your long-term objectives, and by doing that you maintain this balance. Managing debt is vital. Internal debt, meaning any debt that you might have, whether it's investment debt or other debt, it's important to make sure that you have the wherewithal to be able to maintain payments in a recessionary climate. And external debt is particularly important because if you're invested in investments that have internal debt within them, and there's a recession, for example, we saw it happen particularly in 2007, 2008, where property prices fell dramatically, and companies with high levels of debt within them just went broke. And of course, we saw some companies breach loan covenants, attacked by the short sellers, went broke. So it's important to know where you're investing, what sort of debt is behind it. Managing cash flows is a basic. It's probably the thing we put before anything, to make sure that cash flows are balanced and the balance of the portfolio is such that it's catering for your income needs. And also, most importantly, that never invest in anything that's not a quality asset. To attempt to paraphrase Warren Buffett, it's when the tide out that we find out who's been swimming naked. So we need to be careful that the assets that we're investing in are quality, and that in the time of a market collapse or a market collapse, that those companies have the wherewithal to remain solid and make a comeback. That's the end of my presentation.
You happy to take questions, John?
Happy to take questions.
Thank you very much. I was going to get in first, but you can go first, Chris, if you like. Chris Rannick.
Thanks very much, John. Now, we heard earlier from Gary Seabar about the level of competency in the Land Tax Office of the Victorian Government. Now, I'd suggest to you that the level of competency in ASIC hasn't been much better. You told us that the regulatory regime is robust and strong, but it hasn't worked. And I'll bet that when you have a contest between greed and regulation, particularly self-regulation, greed will always win. Now, I used to go into the office at 120 Collins Street regularly, at least once a week. And as the doors opened at the lift and the people got out at ASIC's offices, I'd see all of these, what I would regard as fairly scruffy individuals, jeans, open neck shirts, beards, but with briefcase, which was probably the executive lunch wrap, get out for a day's work. And I said then, and I think I've said to you previously, when I saw all of that, I said, these guys will never catch anything until the clean-up process happens. I think we've got a real problem in the bureaucracy and the quality of the bureaucracy, and it's probably a fair bit about the money they're paid as well. Comments?
Couldn't agree more. I used to say that ASIC was a place for lawyers who couldn't make it in real life. Yeah, the competency levels are poor. The application's poor. The knowledge base is poor. We actually have. I said we hadn't been contacted with ASIC. We have. A contact I knew in ASIC phoned me and asked me if we would host a group of a dozen of their regulatory representatives or lawyers, young lawyers, and teach them about how financial planning businesses work. So we had them all down for a day, and it was very successful. So they kept on sending them down. I mean, it was just pathetic. These are the regulators. Had no idea. I've had meetings. I had a meeting not long ago with Peter Kelly, Assistant Commissioner, having written to Greg Bancroft telling him what I thought of him, because all Medcraft ever did was shoot his mouth off in the newspaper. Never did anything else. And I sat there with Peter Kell. Now I know Peter Kell well. I've known him for a long time, and I was absolutely amazed at his ignorance of what really happens in the financial planning world. It was just extraordinary. So, Chris, I agree with you on it, and it has to be fixed. And maybe it is. They're not employing good enough people.
Graham, I've got a very simple question. What is a wrap account?
Oh, sorry. A wrap account is it's an administration platform. So prior to wrap accounts, if you went and saw a financial planner, they put you in a whole heap of investments, and they'd hand you the prospectuses and the certificates, say, see you later, go home. But a wrap account actually administers, it's just an accounting mechanism basically. Puts the portfolio into a report, and they send reports out. It doesn't do much more than that. But it's a cost. It charges probably 0.5% just to do that.
Sorry, John, you said it's a con.
A con?
Yeah. Beg your pardon. Yeah, John Howe.
Oops.
I'm taking over. Sorry. Did I understand you to say that a wrap account is a con?
No. No, it serves a purpose.
It serves a purpose.
But it doesn't justify the costs that are applied to it. Like we administer clients' accounts internally.
Yes.
So we have very sophisticated IT systems that help us do all of that. And our clients can get their bank accounts and all of their investments 24/7 online. So we don't actually send out written reports. Our clients can get up-to-date information on all of their affairs through our website. So all wrap account is just summarise your investments and sends out a report. But they charge probably 50 basis points to do it.
50 basis points.
0.5%.
So my Colonial first wrap,
That's a wrap account.
0.9%.
0.9.
0.9% charge is, I can feel I can go home a bit safe.
Well, no, I mean, you're paying 0.9 for a report. I mean,
John,
Kevin McDonald.
you talked about having quality investments. How do you assess quality investments? Because if you look over the period of time, a lot of companies have a significant volatility, often through self-inflicted wounds with the BHP, Westpac, all the banks, and we're now going to a situation where probably the returns of many of the traditional areas like banks will decline through pressure. So how do you assess quality shares? And it obviously goes back to your side of it. How do you go through the process of selecting those sort of investments you recommend to your clients?
well, we have a sort of a multifaceted way of doing that. We buy in research, which is independent research, and then we overlay it with our own filters of what we class as being the measurements for a quality investment, whatever it might be, and then from that we'll make selections. Now, I'm not a big fan of resources company because they're very volatile. They'll go long periods of time not performing and they don't pay much. But the reality is with the banking system that I mean, we've got a 4 pillars policy basically, so they own the marketplace. So if there's banks will always be in our portfolios, not all of them, but the selected ones. And if there's a downturn in a bank, we're more than likely going to buy it rather than sell it. We're very careful. We're high conviction. We'd rather have more of something, a small number of things, than lots of smaller numbers of lots of things. Diversification is necessary, but over diversification just means you don't know what you're doing.
Alan Trumbull, I'm having a little bit of difficulty with your, I wouldn't say hatred, but dismissal of commission selling. Most of my life, people have sold me things that I've often felt, well, I know they're under commission for getting the sale. If they become too expensive, they disappear. Why didn't that happen in the banking sector? Did they collude, do you believe, to maintain a level? Or were there signs of it breaking down as competition became fiercer?
Rather than use the word collude, I remember, for example, some years ago when the company Bankers Trust, which is now part of Westpac, we used to use some of their products at that time, and they introduced training commissions. Now, a training commission used to be called a service commission, but it was no more than a loyalty commission, so it's paying the advisor not to change the investment. So I tore into Terry Bauer, who's the CEO at the time, and he said, well, we've got to meet the competition. So he simply introduced this commission because of the rest of his competition was doing the same thing. I mean, commission selling, when you're talking about investing people's money, is different to commission selling on a product, in my view, and particularly if it's not disclosed. And the industry has gone through enormous lengths to try to dodge disclosure. And I remember back in the 90s, early 2000s, some of you may remember that we had nil entry fee managed products or deferred entry fee managed products. So all that was about was to try and fool the investor into not understanding what the commission was. The advisor was paid the commission up front, but that was taken out of the first 4 years' earnings of the client. Now, that's a con. And we actually raised this at a commissioner's board meeting with ASIC, and they said, oh gosh, that's terrible. Never did a thing about it. It's the way that it's done, and particularly when you're dealing with people's money, they need to know And even though disclosure is part of a regulatory regime, people don't do it. Or they hide it in the fine print somewhere where people don't. So we have clients coming to us saying, oh, my advisor doesn't charge us anything. We say, well, let's have a look at what you've got. And we've shown them how much they're paying and they nearly die. So, I mean, these are the reasons why commission, I don't think. And I think it also undervalues the financial advice. And the saying back when was, well, you can take our advice and you don't pay us anything. Well, because they're getting paid by the product manufacturer. So then you have the issue about the client's advice being influenced by the advisor choosing the product, and he'll choose the product, he or she will choose the product that suits them the best for whatever reason. It just doesn't sit well with me at all.
Thank you. Well, an excellent talk. But could I ask you, do you have any views on, or what your view is on diversifying into buying some American shares?
We do buy American shares, mainly direct. We invest in a couple of specialist outright return wholesale managers who manage American portfolios. Our view is that trying to invest in regional sectors we always have these themed funds like the Tiger funds were in Asia, and then we had the BRICS, which were the Brazil, Russia, India, and so on. Trying to invest in these themed funds is just fraught with danger. But American companies give you international exposure at the top end because they're operating in the global market. So that's basically our view of the world.
Duncan?
To access a wrap account, I need to use a password. If that wrap account is hacked, does that allow access to my investments, or is there a firewall there or something?
There would be substantial security protection.
Yeah.
I know our security protection is huge, but we'd have hundreds of attempts at hacking our systems every night. It's frightening to see, and they're obviously computer driven. They try and try and try and try and try.
Right. Did you have a question, Roger?
Yes.
Yeah.
Barry, put your hand up? No. John, just changing it slightly. Hewison came out, not Hewison, Costello came out a little while ago to say reducing the Federal Reserve Bank, reducing interest rates is not going to solve our potential of going to recession. Now, I've been in the retail industry a long time, and retailers at the moment are bleeding everywhere. There's shops closing everywhere, all over Australia, because consumers are not spending. And this last tax reduction of $1,000 on average per person for a single person has not apparently worked. Yet, as I understand it from an economic point of view, it would be better to have further tax deductions, as what Trump has done to Americans, to continue on. What are your thoughts on that area?
Well, the Reserve Bank's already come out and said that they're going to look at quantitative easing mechanisms to try and stimulate the economy. And
Not working.
Well, they haven't started it. We don't really know what it will be.
Printing money.
Partly printing money, but they're saying that they're probably going to have to look at some other mechanisms. And they've obviously encouraged the government to start spending on infrastructure. So really, it's in the hands of the Reserve Bank and the government to take whatever actions necessary. But I mean, I hear your pain on retail. It's how much is due to non-expenditure and how much is due to online trading. Who knows? It's hard to quantify.
Barry?
John, that raises the question of what advice you give to your clients on investing their cash, knowing that they're not going to earn much on it, does it mean that you're very often advising them to take the risk of investing in shares where the return is 4 or 5% plus franking? Do they accept that risk? Does it depend on how much they've got to invest? If they haven't got much, are you saying just put it in cash? Because you can't take the risk of the market falling tomorrow, the day after your advice is given. It's not easy, is it?
It's never easy. Nothing easy about investment. It was interesting when I retired. I don't do client advice anymore. I didn't realise how much pressure, subconscious pressure there was in looking after people's money till I stopped doing it. So it's not easy. Look, we stick to our formula of rebalancing portfolios to strategic. All of our clients are different. They've all got a different strategic plan. And then we look for areas where we can safely earn better rates of income. So we've de-risked our portfolios over the past few years, where we've taken more exposure into commercial real estate through syndications, which has been enormously successful. But when one investment was paying 10.25%, others are averaging around 7 to 8%. So we're looking at that sector for income. We're invested in some very safe corporate bond investments. We're invested in things like exchange traded bonds, which are large corporate bonds, government bonds. Not exciting, but at least you get sort of in the 3%. We do use shares for, we see that as shares are an income investment, but we certainly wouldn't increase exposure to shares just for that reason. So it's really a matter of looking where we also invest in a lot of secured first mortgages, which we're still getting sort of in the 6.5 to 7.5% per annum. So we're averaging around 5% at the moment, which we've done over the past 5 years, but it's not getting any easier.
Cool. Any more?
Yep.
Oh. Sorry, Barry, then help.
Barry, John.
Hi, Barry.
As an investor in the share market for a long time, there's only two things you want when you retire. An early warning to get out of a share, or an early warning to get into a share. It's very simple.
I don't know.
You can't fail. All right. So this is a question for you and any of your mates in the game. How do you go about warning your clients that this is iffy, and I'm being mild there, I'd rather a brutal thing, sell? Or how do you go about telling, this is very promising, I advise buy, to your clients?
Well, we're not traders. We don't trade on a daily basis. But if we see a signal for a share that has either overperformed and we want to take some profits and go somewhere else, then we'll make a decision based on that. If we see some warning signs on a share that we don't like, then we'll act on that. If we see opportunity through our research, then we'll act on that. But we don't have and we don't want discretionary power. So we have to we contact our clients usually via email.
Alan, you can have the last one.
Thanks, John. Mine goes back to a very early remark about A&P. In a moment of financial genius, I ignored my advisor. When they got to 295, I hopped in, and I'm thinking the great Canadian pension company will sweep down and get all of that property. If you do the sums, they're getting it for nothing. And now they're what, $1.27. Have you got any comment about A&P?
You got to give them a job.
Never invested in A&P ever. Oh, look, AMPs. I know a bit about AMP through friends of mine who held high positions there. They went on a huge spending spree by buying out self-managed superannuation fund administration platforms and services, and their whole purpose was to fill them with AMP product. It was never going to work. I mean, by and large, a self-managed superannuation fund shouldn't have managed product in it, or not much of it anyway. I mean, you're just doubling the cost. And the notion that they were going to be able to, they just made some stupid decisions. And at one stage, a good friend of mine, Stephen Helmich, who was head of their advice area, he dragged them kicking and screaming out of an insurance agency profile into a qualified advisor profile, and he introduced the certified financial planner designation into AMP and said everyone had to get it. But at the end of the day, AMP thought it was commercially unviable, and they went back to their different regime. Yeah, and I think a lot of those, I mean, the graveyard's full of failed insurance companies, aren't they, over the past 20 years, just being sold off, and all of the major banks have sold off their insurance businesses. I don't know what AMP's going to do. They last week, I think it was, they said they're going to join their wealth business to their bank and try and reconfigure themselves, so I don't know. But they're a bit of a basket case.
Oh, well, thank you very much. We'll ask Rob to come up and thank you. But it's interesting that your comment that we're not as bad as it could be in terms of overseas practices.
Look, on the good side of the fence in Australia, we could have sensational financial planning firms and really good people. But you just don't hear about them. Because all the newspapers full of the bad stuff.
It was very nice to meet John over a cup of tea earlier today and discovered that we had the same views about politicians, bankers, auditors, and a variety of other people. I reminded him of Billy Connolly's comment, which was about politicians, which was, don't vote for them, it just encourages them. And that might be true of some of these other ones as well. John, thank you for your presentation, and the fear perhaps you've put in some of us, but hopefully there's a light at the end of the tunnel. It reminded me, my daughter, as head girl of a school back in England, had to give the thanks to the politician who was the speaker at the end of term. And she made the comment that he must have been interesting because I hadn't fallen asleep. I haven't noticed anyone falling asleep today, so it must have been interesting. Thank you very much indeed.
Thank you.
Thank you very much, John. Do you want some notes, John, or you?